Phillip Streible is Chief Market Strategist at Blue Line Futures. Phillip, and I guess I want to start there with just sort of what you're really kind of hanging on and looking for, whether you've seen it this week or whether it's coming in the weeks ahead. Maybe it's next quarter's earnings reports. What are you kind of waiting for to see to kind of resolve some questions, if you have any, about where markets go?
Well, a lot of it has to deal with the Delta variant, and if it continues to shut down different countries, I mean, that could really play a damaging role in also, how the Fed is going to react when they're going to particularly taper, when the discussion about implementing it is going to happen as well. So we do believe that, this is still continuing to be a recovery-based growth model here. We're going to see U.S. equities continue to charge on. Today's correction is just, it's just episodic. It's non-trending. This is not all of a sudden we're starting some massive down phase. And you could see how quickly investors came in with the Dow down 500. They cut those losses in half. And we believe that economic data is going to support the jobs recovery. That's the biggest question. And today was a setback on that jobs recovery. We believe that it's going to take another 12 to 14 months in order to achieve those pre-pandemic levels.
So one place that we've been seeing some of that, I guess, being factored in the macro elements has been in the energy sector. Walk me through your thinking on what's happening with oil. We got OPEC in the mix here, and I guess you could have seen it coming in some ways, right, Phillip? That at some point disagreement might start to fray around what to do on holding the line. But what do you think of the price of oil and whether it's justified at these levels?
So the range that we're seeing on crude oil, 71.50, that was a great buying opportunity this morning on oil coming into that inventory report. Our signals do indicate that we should see another high up at $76. We believe we'll have a strong bounce back. The inventories are about 445 million barrels. Right now, that 5-year average, 477 million barrels. So we're significantly under. It is a tighter market. You do need to continue to see other areas recover, like cruise ships, like airlines, and that demand come back. The driving has been at pre-pandemic levels. So we've come back there. And gasoline did reflect that here, that there was quite a bit of travel over the last couple of weeks with a big drawdown of 6 million barrels. We are tighter than that 5-year average, but it has fluctuated back and forth. That's what stalled out the rally. I do like oil to the upside. I think we'll see $80, $85 in the next quarter.
And just in terms of kind of other catalysts out there, I mean, we know there's this kind of disconnect in the labor market, and you're actually giving it quite a long horizon to really fully normalize. Do you think that will show up in different ways, including in wage increases and therefore a hit to profit for businesses between now and then? Are we going to start to see it show up in maybe third quarter?
It seems that businesses are trying anything they possibly can to get employees back, whether it's in the office, through those wage increases. There's a lot of flexibility with it. There is a lot of arguments over, different governments or different states extending those unemployment benefits, how that impacts it. That's really been a politicized aspect of it. We are seeing every place in the United States, every major city that I've been to recently, and I've done quite a bit of traveling, has those help wanted. And it's not only at an entry level, it's all the way across the board. So the businesses are waiting there with the doors open to hire the employees. It's how do you get the employee, out of their house and back working in the labor force?
And, obviously that is going to be, as you say, different for different sectors. We're seeing bets being laid on inflation. Wage inflation is one place historically we would look to see whether anything takes hold. Where are you in the camp? Or do you think the bond markets are accurately pricing in benign inflation for a long time?
Yeah, I disagree with where treasuries are at right now. I believe that treasury yields are going to ramp higher. We're going to see some acceleration, back up 175 on the 10-year note. So we have been putting longer term bearish plays on the 10-year. We've seen a lot of liquidation on those longs that have come back up to break-even levels for people, and they are starting to target the downside in TLT, in the 10-year note, in the 30-year note as well.
I want to talk about gold as well, just in terms of what you think might drive it. I think we can say inflation concerns haven't been driving it lately. It doesn't seem anyway. What are the catalysts for gold, do you think?
Gold's actually been like one of the worst performing commodities for the year. It's down like 6-7%, although it has a strong recovery as yields had stopped rising so aggressively. So the negative real yields that we're seeing right now, that's caused that recovery. We're in a trading range between 1775 and about 1825. So our active clients have been trading that range specifically. The Fed, how they're going to handle things, if they start talking about this taper and you start seeing the economy recover, you're going to see that setback, but they don't know what the long-term lingering effects of the amount of quantitative easing that they provided out there. Also, there are a lot of systemic risks from that Delta variant. It could easily shut things down. You could start to see countries start to backpedal on their tightening, and they start to implement more easing measures.
And then I guess by proxy sometimes, but maybe not, what do you think of it where silver trades from here?
See, silver that's been really disappointing. We do have longer term out to March. We've got the 29-31 call spreads on. So we have in our back pocket, the river card where if we do get an explosive move, the clients will benefit on it. The futures contract, it's been in a bullish trend. It's got definitely a different chart pattern than gold. We do like anything below $26 on the long side, but when you start getting up closer to 27, you got to let it go. It's another trading vehicle with the call options on the back end for an explosive move higher.
So obviously we're talking a lot about how many commodities that were sitting at incredibly high levels have traded off of those levels, lumber being one of them that we've talked an awful lot about for a whole bunch of different reasons, including because Jay Powell referenced it in the last meeting. Is the big boom, is the bloom off that rose? Are we going to continue to see declines? Because historically you still got pretty high price. It's not unlike oil, right? They're still at pretty high prices. They're just not at the incredibly elevated prices of weeks ago.
I could tell you that I just purchased a home and there's going to be some massive renovations for it. And I had a bit of sticker shock yesterday when they were telling me what those costs would be there. So, although the price of lumber has been halved on the futures contract, we definitely haven't seen that trickle down effect into the prices back at, lumber yards and where these builders get it from. I think that it still relies a lot on those logistical issues. People at the sawmills, employment coming back. I called personally many of the sawmills and discussed what was going on there. And it was just because of the fact that those employees are not coming back to work. And then it just becomes, a series of events that's causing these prices to remain elevated for the consumer.
And I guess I should ask, I'm sorry to hear that about the high prices you face, but just as we look kind of down the road, one of the big questions has been how transitory is all of this? From what I'm hearing, businesses are trying to hold off on passing on costs. They're trying to do everything they can to get labor back. Would you expect to see price increases? Are you looking for margin contraction because of some of those higher input costs?
If you go to restaurants, you're going to see those costs. They're directly passed on. It's across the board. All the way from Chicago, you'll see that they've actually included some additional percentage on a lot of the costs of the consumer that are like almost a COVID tax that's been implemented. So these costs are definitely being passed on. You're not seeing the consumer really benefit anywhere. Really, maybe in the airline sector, it's still pretty cheap to fly around to different areas in different cities. I'm sure cruises are very inexpensive as well, but it just seems like some of these transitory inflations are going to linger longer than expected.